So the first speaker is Professor Fred Hilmer. If you could come up to present. Fred, obviously renowned for his major contribution to competition policy in Australia, and Fred is also a director on the board of CIFR, so please welcome Professor Fred Hilmer.
Thanks very much. One of the great successes of the competition policy work was the regulation review process. We articulated some principles in the report, the main one being there should be no regulatory restrictions on competition unless clearly demonstrated to be in the public interest. And that was put into effect through a process where governments were paid competition payments to review regulation and to, in a sense, take out regulation that had anti-competitive effects and no offsetting public benefit. The Productivity Commission estimated that those changes to regulation, something like 1,500 pieces of legislation changed, had a very significant impact, lifted GDP something like 2.5% above what would have otherwise been the case. It's interesting in reflecting on the financial sector, that the financial sector and the regulation of the sector, to the best of my knowledge, was never subjected to a competition review. It's been subjected to major reviews. You've talked about Campbell and Wallace and now Murray, but they're quite different kinds of reviews, and competition tends to be one of a number of issues, and only, I think, in this review, a major issue. I think if you take a look at Wallace, competition wasn't really a major issue. So, and you know, in the reviews of banking that have been done, the issues are much more about stability of the system, fairness of the system, and the concern is really very much prudential. And if you want to deregulate, the onus is on you to show that it won't in some way increase risk, which is quite the opposite in a competition review, where the onus is on the person who has regulation in place to prove that that regulation has some societal benefit. So, you know, I thought about, well, why is that the case, and is that a good way to go? Well, firstly, I think the financial system is quite difficult to deal with for a number of reasons. Firstly, regulation, particularly with respect to system stability and consumer protection, is really critical. And if you get a bank failure, or if you get a failure of a financial institution, you've got a quite different order of magnitude problem than if you close a car plant. I mean, car plants come and go, and textiles industries come and go, but the consequence of a bank failure and the restriction of credit to the economy is very, very, very severe. Secondly, the competition issues and the stability issues are completely intertwined. You know, if you take the example in the interim report, a different approach to risk weighting may tilt the competitive balance in favour of major banks. And so how do you remedy that? Well, if you remedy it in a sense by taking the foot off the regulation for smaller banks, then you might hurt stability. If you remedy it by penalising the big banks, then you might help stability, but you hurt competition, and you certainly hurt cost effectiveness. So, you know, intertwined issues. The third reason is, as David Murray said, we're not operating in a world on our own. We're operating as part of a regulatory framework, and so we've got to look at not just competition in the domestic economy, but the impact of regulation and competition in the broader economy. And then lastly, the reason I think no one's done a competition review of banking is because you wouldn't know where to start. And that's what I'm saying on the chart. Banking or finance is actually a number of industries, and each of them have their own competition issues. I mean, for example, in banking itself, it's really one about market structure and the way in which regulation affects competition and entry. And then, you know, if you look at payments and financial markets, you've got a small number of players, and what's evolved, almost independently of what's evolved in other sectors, is an access and pricing regime which is regulated by the Reserve Bank. Then you come to the wealth management and superannuation, and you're really dealing with the question of information asymmetry and the extent to which, therefore, a market is hindered. So you've got a range of issues to deal with. Really raises the question then, should we be doing competition reviews of banking regulation as new regulations proposed? And if so, how should they be carried out? Now, my bias is that we probably should do those reviews, should do them when new regulations are proposed, and there is a generic process through the Office of Best Practice Regulation where people who propose new regulations need to justify that regulation in the public interest. But there's a few problems with that. The first problem is that the process is really in fairly sad shape. It's a point I've raised with Ian Harper and written about. The Office of Regulation Review is not resourced to do, I think, leaving aside banking, most of the ex-ante regulation review that you want to see. So we've got a problem there. Then raises the question, who should do this? I think there's a good case for involving a number of players. I mean, you need, for example, the expertise of a reserve bank, you need the understanding of the regulator itself, and you need a voice of competition, whether it's ACCC or NCC, if that were to be revived or reinvigorated as a result of Harper's work. So you also have, I think, an interesting question of when you do that, where the onus is. Do you take the onus on the person proposing the regulation, or is it the onus on the person who's saying we should somehow become more competitive in a particular area? If we're going to do that, the onus is on a person to prove that system stability, prudential issues aren't going to raise their ugly heads. And then you get the question how you do it. I mean, reading the interim report, it's sort of on the one hand, on the other hand. On the one hand, a competition impact, on the other hand, a prudential impact. You can't really make those trade-offs by just dealing in generalities or dealing in principles. You've actually got to do very detailed microeconomic analysis, what-if analysis, how often might this risk occur? If it occurs, what impact will it have on the different players? And so you need a level of expertise that, as I say, just isn't there and needs to be assembled if you're going to do those competition reviews. So I would argue that I would say, firstly, delighted to see competition getting a run in the Murray report. It is, however, sort of a one-time look, and then it won't be looked again for 20 years unless you bring the financial sector into the competition policy framework. I think there's a case for doing that, but I do think it isn't just taking what we have in place today and saying it will apply to the financial sector. I think one of the points I hope the Murray report addresses is, if they agree with me that it should be brought into the competition policy framework, then how that might occur needs some thought, how you assemble the right skills. So let me conclude by speculating on some of the issues that such a competition review might raise. I mean, on the face of it, if you look at banking, if you look at the structure, I've got a question mark there, but actually if you look at it from a competition point of view, 4 large players, other significant players, a Macquarie Bank, and a number of smaller players. And, in most markets in Australia, you would think that is fantastic. I mean, we don't have that number of significant players in most of the other industries. So John Howard talked about, two dominant players in retailing, and relatively few players in airlines, and so on. So it looks like it's very competitive. But a couple of things bother me. One is, with the exception of Macquarie Bank, who entered a long time ago, where is there a significant new entrant that is in some way or other brought a new competitive challenge to the industry? And what seems to happen is they come and then they go. They don't seem to be able to survive, and we've seen that with regional banks, we've seen that with mortgage broking. And moreover, while we've got 4 players, the 4 players look very similar to me. and I say this as a non-banker, but their cost structures seem similar. Their business mix and revenue models seem similar. Investor expectations of them are similar. They use a lot of shared facilities, like a shared payment system, so they have to deal with each other all the time. And I think that the differences, such as slight differences in the mix of business, which I think have actually got less over time, and offshore participation are really at the margin. You know, when you look at the size of the entity, the differences are at the margin. And lastly, you know, the four players all have excellent information about what each other are doing. There's very little sort of opportunity, as say in the industrial world, for someone to come up with a patent and that gives you some proprietary information, and you can drive that into the market sort of some proprietary way. So all banks have to do is do their optimal strategy, and it looks like they're colluding, because for each of them, if they're so similar, the optimal strategy will be similar, and you come out with a fairly common set of then responses to whatever is going on at the time. If everybody acts logically, they act similarly. And this is really quite different to other industries. I mean, if you look at the entrants in retail, and we've had, you know, a number of entrants in retail, we've got Aldi, Costco, Metcash. Every one of those comes in with a quite different business system. And that's how competition occurs. If you look at the car industry, you know, competitors in the car industry, the emerging Japanese, now the emerging Koreans, then the emerging Chinese, they all come in with different cost structures, different business systems, different technology bets. And so I think, you know, if you have a competition review, you really need to understand the way in which regulation is causing this similarity and understand why that similarity exists and the extent to which it's an unintended consequence of regulation. To what extent does the shared infrastructure that they use contribute? And then, you know, an important question that David just mentioned, to what extent is technology likely to either exacerbate the system that we have or break it open? To what extent are the major bets that banks are going to be required to make with respect to technology, are those bets going to take them in different directions with different platforms and, you know, with different cost structures, therefore with different revenue incentives that might encourage the differentiation that characterises what I think are vibrant competitive markets. So conclude by saying it's great to be given a platform to ask questions. It's much harder to have to answer them, but that's the inquiry's role. But I think these are important questions, and my main concern is that competition issues in banking, I think, could benefit from a greater, sharper, better resourced and more frequent attention than has been the case historically. And I look forward to hearing the FSI's deliberations and recommendation on these issues and competition in general. Thank you.
Thanks for that, Fred. We might have the next question if we can. People are voting already. Obviously attracted a lot of comment since issue of the interim report. I attended the public consultation last night. Some of you may have as well, which the audience of which seemed to have been stacked by the Citizens Electoral Council, and I wondered if we had posed this question last night, what the results might have shown. Okay. Well, thanks for that. We might now move on to our next speaker, Professor Deborah Ralston, on the funding section of the interim report. Please welcome Professor Deborah Ralston.
Thanks, Anthony. The interim report makes 3 observations in the section under funding. The first is about our reliance on foreign capital, and indeed we have been one of the highest investing countries in the world, also a high savings country. But it's that important reliance on foreign funding that is really critical and also raises issues for stability. Secondly, the report acknowledges that there are some limitations on funding to SMEs for various reasons, and also that there are some limitations with respect to the development of the corporate bond market, or domestic bond market, I should say. I'm going to talk to you about 3 issues today, and the first 2, funding innovation and funding SMEs, are to do with how efficiently we allocate our financial resources and how well the system does that. And secondly, I'm going to talk about the issue of the bond market, which touches on the resilience of our financial market infrastructure. I'm a little nervous because I've got to say so much in 10 minutes, sorry. I'll stick to the script. Funding innovation. Let me start out by saying this is a really complex issue, and it's not just about funding. It's about innovation ecosystems, better collaboration between business and research. It's about incentivising commercialisation, and I've just seen some reports recently about the patent box scheme in the UK, which has been very successful. And actually, I've noticed University of New South Wales Easy Access IP, those kind of initiatives are really important for innovation. But when it comes to funding, there's very little mention of this in the report, with one exception. Some talk about the venture capital limited partnerships and the tax advantages they offer. But from recent work we've been doing, we'd have to say that the VC system's really not working. Around 0.02% of our GDP comes from venture capital investment. That compares with comparable companies such as Canada, we're about a quarter of that level, and an aspirational country such as Israel, we're about a 20th of that. As the report says, VCs established between 1985 and 2007 have had a pooled internal rate of return of minus 1.4%. And the model used by VC companies, the 2% management fee and 20% of returns, is really not attractive for many startup businesses. But the good news is that there's been a huge rise in alternative funding for this sector. And indeed, from evidence in Australia and in the US, around 80% of early stage seed and startup funding is now coming from non-VC sources. These non-VC sources include high net wealth individuals, angel investors, family offices, business incubators, etc. We also see in technology the emergence of online deal platforms, crowdsourcing, which KMAC said something about recently, and other technology initiatives which are reducing the information asymmetry, connecting sources and users of funds. So I guess that when we look at this system and how well the financial system is serving innovation and startups, which are critical for economic growth in the economy, we'd have to say that looking at tax incentives that encourage investment outside of the VC system and extending those benefits would be well worthwhile. We've seen some schemes from around the world, like the Seed Enterprise Investment Scheme started in the UK, having great benefits in that regard. I'm going to talk now about funding SMEs, and it's been touched on, I think, already by David Murray. Around the world, you can see internationally there's been a really long-term structural change about the provision of credit to SMEs. And there have been 3 really major trends that have been driving this change. Firstly, there's been ongoing consolidation in banking systems. As banks have gotten larger, and this applies not just in Australia but everywhere, and credit systems have been centralised, there's been an increasing distance between SME borrowers and lenders. It's become more and more difficult for these large banking institutions to deal with what is very complex small loans. And that leads through to the issue of costs, the costs of credit assessment. They're very real. It's very difficult for lenders to carefully assess the risks involved in small business. They're high and they're complicated. They're not just about reading balance sheets or cash flow statements. They're about understanding the skills of the management. And it's an area where we've lost quite a few skills over recent times. Banks revert more and more to credit scoring models, and that has some benefit, good use of technology. However, the possibility of type 1 error, of dismissing firms that are high potential growth firms, is quite high, because a high growth young firm will tend to look in its financial profile something like a bankrupt firm. It'll have very low liquidity, few assets, and a pretty marginal kind of solvency. The third big trend has been about regulation, and we've talked about regulation versus stability versus competition. There's also an issue of stability versus growth, I think, in this respect. As you can see in this diagram here, and I think I've got a little thing here. Oh, no, never mind, I won't try and do that. You can see that the blue line is total credit, the red line is change in business credit. And you can see that total credit is moving ahead of business credit, particularly in that period leading up to the GFC. If you have a look at the introduction of risk-weight capital weightings in about 1988, you can see there's something of a divergence occurring as business credit is much more capital expensive, but it's really with the introduction of internal risk-based models from the late 90s that you see a real divergence. If you looked at those figures, and this graph kind of demonstrates that since 2008, in the last 68 months, there's been a modest but solid positive credit growth for housing. There has been a negative monthly credit growth for business, and that includes all business, corporate and small business. According to the IMF, we have around the highest proportion of real estate on any set of bank balance sheets, 63% residential loans and maybe another 10% commercial loans. So banks have responded to the increasing risk of small business in a rational way. They have reduced their commitment to it. But these are really long-term trends, and I've been talking about supply conditions. There are also demand conditions, and really the GFC has really just accelerated in many ways these long-term trends. Demand for credit from SMEs and corporations has declined since then. There's been an increasing reliance on internal funding, and for the larger companies, a real diversification in funding sources. For SMEs, though, they're often referred to in the literature as being bank dependent, and indeed our SMEs rely entirely, pretty much, on banks for funding. And in fact, 90% of funding for SMEs comes from the banking sector. Now, ABS statistics show that around 80% of business loans are approved, and that's kind of a surprising statistic when you hear me talk to you about the conditions for small business lending. The margin on small business lending is now roughly twice what it is for large business lending. There's an increased use of security by lenders and an increased use of, what's that word? I think I've written it up there. Conditions around the loan. I've forgotten the word. So in many ways we're seeing is that it's not an attractive form of funding for many kinds of covenants, both negative and positive. And those covenants are really quite strict these days. So how many people are applying, being deterred from applying for loans is another question. So we think that while there's a growth in technology, in organisations such as the Lending Club and Security One, who have cost-effective means of assessing small business loans and monitoring them. Maybe that might transfer into the banking system, as David was suggesting. There are recommendations in the interim report, and these are the ones that we think are worth looking at. Very briefly, on the corporate bond market. Corporate bond market is about 1.2 trillion in Australia. The listed market is 280 million. 1% of households have fixed interest securities. We think there have been some impediments to the growth in this market, and in terms of developing a resilient domestic financial market infrastructure, we think there are things that need to be considered. In conclusion, I guess we've talked repeatedly this morning about the fact that Australia has a highly concentrated business sector. We think a key priority for the FSI should be to think about that issue, and poor people, I think they've been incredibly consulted with a very short timeline, and we really need to make sure that funds are flowing through the financial system to areas which will lead to growth and greater diversity in the business sector in time to come. Thank you.
Thank you, Deborah. We have a question to follow. This is an idea that has been identified as possibly part of the solution in terms of meeting funding needs for the SME sector. So please take the time to submit a response. Okay. Thank you. Our next speaker is Dr Geoff Warren. Geoff is Research Director at CIFR, and he's going to present on the superannuation section of the interim report. Please welcome Geoff.
Thanks, Anthony. Given the short amount of time, I'm going to focus on two issues. I'm going to focus on fees, which seems to be the hot button issue in the super area at the moment, and also say something on portability, which links into some research we're doing on long-term investing. First thing I've got to do is work out which way I go. Right. Ooh. Let's see. I am going the wrong way. Aha. Okay. The general message I'm going to put out there on fees is there's more evidence is actually needed in this area. What we really need to do is understand why fees where they are. And I actually don't believe that the FSI is going to get enough information on that prior to its conclusion to actually make informed policy decisions. And looking at this issue, there's three areas which could be pushing up fees, three explanations. One is that providers are making excess returns. A second is there's inefficiencies in the system that are pushing up costs and hence being passed on in terms of higher fees. And the third area is there's actually high cost but value-added services being offered associated with superannuation funds which are costly to provide. I actually think that third explanation is one of the most important ones. And how you would respond to each of these is different. You know, if it's excess returns, you try to work out who the rent seekers are and why competition's not working. If it's inefficiencies, you don't know why and where and what you do about it. And if it's higher cost but value-added services, the question is, are members paying for services that they don't value? And this is a very, very nuanced and convoluted area. It's much more nuanced and convoluted than it seems at the face value. You can't just look at the average fees and make conclusions. And I think system design is a key link here in the chain. And let me provide a sense. And I'm going to just pick on a chart that got a lot of coverage it's from the Grattan report. It was picked out in the FSI interim report, and it basically concluded that when we take the median, Australian is above the average. So that's where that $7 billion of fee reduction potential came from. And part of the emphasis there was Australia, as a fairly large system, should have lower costs. but there's 2 dots on those charts. The yellow one's a DB and the blue ones are DC systems. All the DB systems are much lower in cost, and there's a reason for that. DB systems have one fund, usually, to look after. They don't have the client servicing. They may have a different asset allocation and a cheaper one. And if you actually just took the median of those blue dots, well, guess where Australia sits? Right at the average. Now, I'm not saying that's justified. What I'm saying is this is a pointer that's a complex issue. So what could be pushing up the system costs? The FSI Interim Report did a good job of listing some of the possible influences and higher costs in the system. What I'm going to do is actually look at them in a slightly different way and say that a lot of them have to do with the fact that there's a lot of value-added services in the Australian super system, such as asset allocation, a higher exposure to growth assets and alternatives, which are more costly to manage, greater use of active management, which I'll say a bit more about in a moment. A big one is choice and all the associated architecture that goes with choice. Many products, portability, advice, marketing and so on. Member servicing and administration, insurance bundled with superannuation, and regulation, well, value-added question mark, but it is the cost of providing system integrity. Other influences are related to suspected inefficiencies in the system, and the 2 that were highlighted by the FSI Interim Report were fragmentation, too many funds, too many accounts, and the presumption that active management involves a dead weight loss. Now, I'm going to say something on this. This is a big area of research that I've looked at in the past, and the conclusion is with the question on active versus passive and whether it's worth the cost is it all depends. It's very dangerous to make a blanket presumption that active or passive is better, despite the way the debate usually pans out. And the first thing I'd say is be very wary of generalising based on the US findings. The US is the biggest market and the most efficient market in the world with 95% institutional involvement. It would be not surprising you can't make excess returns there. In Australia, the evidence actually suggests active managers have done reasonably well. This comes from the Mercer database. Over the last 20 years, the active managers in that index have beaten their index by about 1.2% per annum. Question is how much fees you've got to pay for that. I'll answer that in a moment. But that's actually backed up by a range of academic research in Australia, which shows that you do get value added in active Australian equities, particularly in small caps. But what my real message is not making a case for active. I'm making a case that it depends on the market you're talking about. Some markets you're better off in active, others you're better off in passive. It depends on the investor, what fees they're going to pay, what access they've got, what capability they've got to select managers, and it depends on the availability and efficacy of the passive alternative. And sometimes passive indices are not the most efficient way to address a market. My conclusion here is that this should be actually left up to the trustees and the management of funds to make the decision. But with a caveat, they need to be informed and they need to be aligned. I think the answer to this active versus passive debate is in governance. It's in making sure that the people who are making the decisions are aligned with, properly aligned with members and properly exercise stewardship. And I'd say this is a general point a side point I'd like to make about the inquiry. It tends to be looking for answers in regulation and product, but some of the answers could be in sort of firming up some fiduciary duty and stewardship. Moving on now to price discrimination. Price discrimination is rife in financial services, particularly in investment management and in superannuation. Now, I'm going to put up some numbers here about what you get charged for an active Australian equity manager and a passive one down the bottom. And the basic message is there's a big divide between what the retail investor pays and what the wholesale investor pays. And there is a relationship with volume. So if you're a retail investor for an active Australian equity manager, you could pay 1 to 2% going directly. If you're big enough to call yourself a wholesale investor, you may pay 0.9. If you go for your advisor, you're going to pay platform fees and advisor fees and perhaps pay 2% plus. It's a bit harder to tell that one. if you look at what if you're a big fund manager, sorry, an institutional fund like a super fund, you could pay as little as 15 or 20 basis points for volume. It's a big difference. Now just remember that previous chart, 1.2% average alpha, different position if you're retail and wholesale. The interesting thing is you'll even see it in Vanguard, 75 basis points down to negotiable. So very, very big differences. And if I could work out what, now that is deadly. Help. Okay. All right. I'm going to put up a chart. Can you flick it forward for me? I was going to put up a chart as well about my super funds and the fees they're charged there. Sorry? Sorry? No, I'm all right. I can remember my slides. Okay, I can just talk to them. Hit the wrong button. Okay, so on my super funds, generally there's about 1% is what's being charged for my super fund of the $50,000 balance, with an exception that the active funds, actively managed retail funds, charge about 1.3%. So that looks pretty expensive, doesn't it? It's not as simple as it first seems, because that's what pays if you go in through your advisor or something like that, if you buy direct. There's discounts allowed for administration fees, so that retail fund could be offered to a large corporate plan for 60 or 70 basis points less. Again, price discrimination in the market. One other final thing I'd like to say before leading this slide is to pose a question which I think is worth answering. The not-for-profit sector charges about 1%. Why? There's no profit incentive there. You can presume there's a reasonable alignment with the members, yet they find it necessary to charge 1%, which is about the number we're talking about in the system. So why is that the case? What is causing them to have to charge 1%? I think it's an interesting question. I don't know the answer. I'd love to do the research. So to wrap up on fees, my response is, I think there's insufficient evidence for the FSI to make informed policy decisions in this area. Further research is required on what drives fees, what determines them. 3 things I think are worth focusing on. Firstly, what's the cost versus benefit equation? Not just cost versus benefit. And the key question there is there value for money in offering so much services bundled up in superannuation? The second is, what's the basis of that price discrimination? Are retail investors paying more because they're more costly to service and they're getting more services attached to what's offered to them, or is somebody actually extracting money out of them and making rents? And the third question I think is worth asking is, why are those not-for-profit fees are at about 1% without a profit motive? Final warning on this area, beware of the unintended consequences. As soon as you regulate to design to get costs lower, something else is going to give. Some sort of services are going to be given up. Is it a good thing or not? And we saw that with MySuper. I'll just flick over now, given the time, to portability and wrap up there. So the FSI Interim Report for us for comments on portability, where we've got about 3-day portability in Australia, definitely worth considering. The problem is there's a trade-off here. Portability has costs as well as benefit. Liquidity is good, but you have other issues. Liquidity management, it impacts your investment strategy and your asset allocation, has implications for diversification, harder to achieve, has implications for long-term investing. This doesn't encourage it. It has impacts for the amount of cash you've got to hold and hence returns. It has impacts on returns because because the redemption activity has an externality that imposes costs on others on the funds, right? And also there's a member equity around the unit pricing. And so the response I've got to this is that easing of the portability rules is a very sensible thing to do, because there's trade-offs here, and in certain circumstances extending portability is a good option to have. A principles-based approach has a lot of merit to it because it provides the flexibility. So thanks very much for listening to me. I think we can have a question now from Anthony.
Please, thank you. I think Geoff did a really good job of giving you a sense of the complexity in the superannuation industry, identifying some of the key participants, the retail dimension, the fact that there are retail consumers buying services, there are institutions buying services, and obviously there's distribution that's critical, there's the funds management sector. It all makes for a very challenging exercise if you want to undertake market or industry analysis. The question here is just to get a general sense of your perception around competition in the sector. You're happy to indicate yes generally, competitive but in part, one or more parts only but not other parts, no seems to be popular, or neutral. And just based on public comments from David Murray and others, and reading the press, it's obvious that this is getting a lot of attention within the Secretariat and the panel. And no doubt there'll be some very robust submissions submitted by Tuesday. I think that tells the story. So with that will conclude the session for this morning. I'd like to thank again all of our speakers this morning. We now have a morning tea break just out in the foyer for tea and coffee, and we will resume at 11 o'clock. So thanks for your attention, and we'll be back then. Thank you.